As the market closed on Friday, September 5, 2025, SoFi Technologies, trading under the ticker symbol SoFi, concluded the session at a price of 25.6, marking a modest gain of 0.87% for the day. This seemingly straightforward closing figure, however, masks a turbulent reality brewing beneath the surface of this fintech giant, a reality that diverges sharply from the prevailing market narrative of a straightforward growth story. The common perception paints SoFi as the quintessential modern financial institution, a one-stop digital shop for the ambitious millennial and Gen Z consumer, rapidly accumulating members and expanding its product suite. While this is undeniably true, the expectation of a smooth, linear ascent to fintech dominance is a dangerous oversimplification. The deeper reality is that SoFi's stock is a battleground, caught in the crosscurrents of macroeconomic headwinds, intense sector competition, and a constant, demanding pressure to prove its long-term profitability and sustainable growth model. The stock's recent performance is a testament to this underlying tension, with daily trading sessions often characterized by significant volatility. The trading volume on its final day of the week stood at a robust 71.3 million shares, indicating a high level of investor engagement and, equally, a high degree of uncertainty. This is not a stock for the faint of heart. It is a high-conviction play on the future of finance, and the market is deeply divided on its ultimate trajectory. The recent discourse surrounding SoFi has been heavily influenced by its impressive second-quarter earnings report for 2025, a release that, on the surface, appeared to be an unmitigated triumph. The company announced a staggering 44% year-over-year increase in adjusted net revenue, a figure that sent ripples of excitement through the retail investor community. This was accompanied by the addition of a record 850 new members, bringing its total to over 11 million. Such numbers feed directly into the optimistic expectation of a company on an unstoppable growth trajectory. However, the institutional response has been more measured, even skeptical. A closer look at the institutional activity reveals a complex and often contradictory picture. While some major players, like Valoridge Investment Management and Bank of America, significantly increased their positions in SoFi during the second quarter, others, such as Susquehanna International Group and Cube Research Technologies, have been aggressively trimming their stakes. This divergence in institutional sentiment underscores the fundamental debate surrounding SoFi's valuation and its ability to navigate the evolving economic landscape. The bears point to the persistent insider selling as a red flag, with several key executives offloading significant portions of their holdings in recent months. While not necessarily an indicator of imminent doom, it does raise questions about their long-term conviction at the current price levels. The fintech sector as a whole is at a critical juncture in 2025. The era of cheap money and unbridled growth has given way to a more discerning and risk-averse environment. Issues such as cybersecurity, regulatory scrutiny, and the ever-present threat of a recession are casting a long shadow over the industry. SoFi, despite its innovative prowess, is not immune to these challenges. The company's heavy reliance on its lending segment, while profitable, exposes it to significant credit risk. A downturn in the economy could lead to a spike in loan delinquencies, putting a strain on its balance sheet and profitability. Furthermore, the competitive landscape is becoming increasingly crowded, with traditional banking giants and nimble fintech startups all vying for a piece of the same pie. The expectation that SoFi can simply out-innovate its rivals indefinitely is a precarious one. The reality is that the company must constantly evolve and adapt to stay ahead of the curve, a challenge that is both capital-intensive and fraught with execution risk. Comment below with your thoughts on whether the increasing competition in the fintech space poses a significant threat to SoFi's long-term growth prospects. Delving into the core of SoFi's operations, the company has successfully built a diversified business model that spans across three key segments: lending, financial services, and its technology platform. The lending division, which includes student loan refinancing, personal loans, and home loans, remains the primary revenue driver. The company's ability to attract and retain high-quality borrowers has been a key factor in its success. However, the sensitivity of this segment to interest rate fluctuations is a constant source of concern for investors. The financial services arm, which encompasses SoFi Money, SoFi Invest, and SoFi Credit Card, represents the company's long-term vision of becoming an all-encompassing financial ecosystem. The growth in this segment has been impressive, but it is still in its relatively early stages and has yet to achieve the same level of profitability as the lending business. The technology platform, which provides infrastructure services to other financial institutions, is a high-margin business with significant growth potential, but it currently contributes a smaller portion of the overall revenue. The expectation is that this segment will become a more significant contributor to the bottom line in the coming years, but the reality is that its growth is dependent on the broader health of the fintech industry. Looking ahead, the future of SoFi is a tale of two potential narratives. In the optimistic scenario, the company continues to execute flawlessly on its growth strategy, successfully navigating the macroeconomic challenges and solidifying its position as a dominant player in the financial services industry. Catalysts for this outcome include the continued expansion of its product suite, the successful monetization of its growing member base, and a favorable interest rate environment. The re-entry into the cryptocurrency space, if managed prudently, could also provide a new avenue for growth. However, there is an equally plausible, more cautionary tale to be told. The risks facing SoFi are very real and should not be underestimated. A severe economic downturn could cripple its lending business, while a misstep in its expansion plans could lead to significant financial losses. The regulatory environment is also a major wildcard, with the potential for new rules and regulations to impact its business model. The company's ability to manage these risks effectively will be the ultimate determinant of its long-term success. In conclusion, the story of SoFi Technologies is far more nuanced and complex than the simple growth narrative that is often portrayed. While the company's achievements to date are undeniable, the path forward is fraught with challenges and uncertainties. The expectation of a smooth and uninterrupted rise to the top of the fintech world is a dangerous illusion. The reality is that SoFi is a company in the midst of a high-stakes battle, fighting for market share, profitability, and the trust of its investors. The current stock price reflects this inherent tension, with the bulls and bears locked in a fierce struggle for control. The coming months will be a critical test of SoFi's resilience and its ability to deliver on its ambitious promises. For investors, the key will be to look beyond the headlines and the hype and to develop a deep understanding of the fundamental drivers of the business and the risks that lie ahead. The journey for SoFi is far from over, and the final chapter of its story is yet to be written. The expectation is of a fintech behemoth in the making. The reality is a high-stakes drama that is still unfolding.